Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a hedge fund manager, and his hedge fund, Barron Asset Management, is famous for its calls shorting the 1999 technology bubble and the 2008 housing crisis. Barron's actually featured him in an article about his correct market calls, and he's a fan of the Austrian School of Economics for decades. I've been talking to him for years about the Austrian School of Economics. He also has a new paid investment newsletter for retail investors. I think it's come out in the last 18 months or so, called the Coffee Can Portfolio. Kevin Duffy, thank you for joining me again.
Jason, good to be back with you.
So Kevin, before we maybe talk about some stocks or bottom up, maybe some industries, I want to get your 30,000-foot big picture thoughts on the global macro conditions based on what governments and central banks have done the last 2 years. So what are your thoughts on the global economy, and what do you think are the biggest risks right now to the global economy?
Sure. Well, I think we can't just start with the last 2 years. I think we have to go back to the great financial crisis, and that really laid the seeds for the great monetary experiment that we've had over the last 14 years or so. And so we already had I'm not sure you would call it a bubble. Maybe you could, over that 10-year period of zero interest rate policy and long running bull market. And then we get COVID coming along. We get a real quick crack in the S&P 500, and then this just massive response. And they print, what do they print? The Fed printed something like $7 trillion, more than doubled its balance sheet. And then we get this wave of stimulus. And of course, a good chunk of that money, the money that was sent directly. So if you looked at that $5-6 trillion in stimulus, some of it was sent actually directly to people through checks, through three rounds of checks. And but that was only for every dollar of that went directly to consumers, $7 went to special interest. So there was a lot of pork involved. So you get this wild experiment. About a third of that money that went directly to people ended up going into the financial markets. We get this wild speculative bubble, unlike anything that we've really seen since 2000. And really, if you go back, it's interesting to look at the Wall Street strategists and barons, the mainstream financial media, and they were all gaga over stimulus. And this is a bipartisan affair. It got started under Trump. It was continued and amped up under Biden. And everybody within the financial establishment was convinced that it would work. And I think also from a bottom-up standpoint, a lot of companies sort of drank that Kool-Aid. They got the stimulus bump and they thought that it would continue. Well, right now, so we had this wild party, and right now we're getting the hangover. And of course, you have other things, external events going on, like Russia invading Ukraine and the sanctions going on, and all the problems in Europe. But I think that we are. We're now moving. We've basically got, obviously, these inflationary problems, but we're in a recession. We are in a recession. Jay Powell said we're not in a recession, even though we are by the technical definition. And Janet Yellen, all the right people are basically saying we're not in a recession. So my working thesis is we're in a recession, and things are tough right now. They're probably going to get worse.
The official confirmation denial from the Ministry of Disinformation, the economic propagandists.
Exactly. And, it's amazing. Their track record is really quite impeccable. And we saw this back in 2007, Jason. You remember the talk of when we got the subprime cracks in early 2007. And, it was the same people. It was people like Ben Bernanke and Janet Yellen saying, hey, no problem. It's contained. We've got everything under control. So that's the knee-jerk reaction, is to try. They're playing a confidence game, and the knee-jerk reaction is always to say that, calm the markets and tell everybody that they've got things in control. But now they're admitting they've let the inflation genie out of the bottle, that they have basically lost control. And so, that's the war that they're fighting, and they're going to have to gain credibility there. So it's not like they can just, I think, stop on a dime. They're going to have to at least establish some inflation fighting credibility, and at least wait until they see signs of the CPI coming down before they go back to the old playbook and print money.
And I think the Fed and these other central banks, they're really the arsonists, the inflation arsonists. They created the money supply growth, the governments cause. And Ludwig von Mises says that governments create inflation. Governments and central banks create 100% of the inflation, not free market, not capitalism, because with competition, new products and services come out. There's innovation that eventually forces prices down, that eventually creates beneficial deflation for consumers. You had a situation, and you brought this up, over $7 trillion in money supply growth, I think, from the Federal Reserve Bank. But globally, if you look at all the other countries and central banks that were running dollar pegs that also printed, I mean, it was many trillions that were created. On top of that, you had less supply in the economy. So you had a food and energy crisis, supply chain problems, and that's why you have the stagflation you have now, because the supply chain problems, here we are 2+ years later since the pandemic started, have not been fixed. So there's all this currency and credit, even with less credit now than there was, 6 months ago when the interest rate hike started or something like that. There's less credit now, but there's still so much currency and credit chasing fewer goods and services, especially for key commodities like the basic necessities.
Right. And yeah, it's been this kind of a confluence of events, and when it's kind of Murphy's Law. When everything starts to go wrong, it all goes wrong at the same time. And I think some of these things actually are transitory. I don't think that the supply chain issues are permanent, but you have a lot of different forces going on in here. This is not just the Fed printed money. That didn't make it any better. I mean, that certainly was a huge part of the problem, don't get me wrong. But, we also had a trade war with China. And, anytime you interfere with trade and you interfere with the global division of labor, you're asking for trouble. We saw it in the early 1930s, and we know where that led. So of course, when you introduce Mises, you mentioned von Mises, and his observation of the economy was, when you intervene, it's always to solve some kind of a crisis, right? And so you intervene, and instead of solving the problem, you create a whole set of new problems. So this is what's going on. We've had intervention in so many different areas. And right now, it's just, it's all blowing up kind of at the same time. So, you have China, the trade war with China. I think that's a factor in what's going on. You've had this NATO expansion and, messing around in Ukraine, which is a very corrupt country. And, there's all kinds of history that has, this didn't just happen out of the blue. There's a long history of our own interventions, and, that's all blowing up at the same time. So then you have, of course, the whole ESG movement. And, you're seeing what's happened. Sri Lanka was the poster child for that. They decided that they didn't need fertilizer, and that didn't work out so well. So this is, all of these ideas are all kind of coming together, Jason. And I think the common thread here is the idea of government intervention, not just in monetary affairs, but everywhere, in foreign affairs, in terms of investment in commodities or energy, all of these things, the whole climate change, all of these things, they all kind of go together in terms of intervention. And, we're now seeing that, it's become pretty obvious that everything is failing. I mean, even the vaccines, that was a massive intervention. And that didn't turn out so well. So, that's the bad news. The good news is that we're seeing the failures of intervention, and they're becoming glaringly obvious. And so I think if we're looking for a silver lining in this, that's what it is.
And we're recording this interview on Thursday, July 20th, 2022. You brought up government intervention. The people in power, they're liars. They're doing propaganda with government economic data. They're saying there's no recession. They're going to blame capitalism. They're going to blame free markets. But if we had more capitalism, if we had more free markets, you brought up the ESG policy. If we allowed these oil and natural gas companies, didn't threaten to put them in jail, didn't block pipelines, didn't threaten windfall profits taxes, didn't block oil and natural gas drilling in the European Union or many other places, the private sector, the free market, capitalism could solve these supply problems. More supply would come online, prices would come down. We wouldn't have natural gas prices here in the US above $8.13. And then that translates into much higher fertilizer prices. And now all these governments correspondingly are making things worse. You're just seeing all these fertilizer bans. I think Canada just put a new fertilizer ban. This is only going to exacerbate the global food and energy crisis. This is not a free market or capitalism problem when a government bans fertilizer because of high energy prices or shortages, Kevin. This is a problem with bad policies.
It is a problem of bad policies, but at the same time, look, I think man's natural tendency is to want to improve his lot in life. His tendency is to specialize, get a job, trade the fruits of his labor with others who specialize, whether it's the grocery store or their own employer or whatever. And so we can't get too gloomy about all this. We've also seen parts. If you look at the world, the poverty levels have gone down dramatically over the last 30 years, unlike anything I think we've ever seen before. So I don't want to just get too caught up in all the negativity. I'm a long term, I'm an optimist. I think if you take a long enough view, you have to be an optimist, because you have to believe that, human beings, each of us are wired to try to improve our own lot in life. And at some point, it becomes just too obvious that where the problems are coming from. So they can, yes, they're going to, play the propaganda game and all the rest of it. But I think we're going to see signs that that people are going to wake up. Now, the woke and the 20%, they'll never wake up. I mean, they'll go to their graves believing what they do. But I think the other 80%, they're up for grabs. And, I think our side, you could call it the remnant, the 5%. We just keep getting stronger and stronger. Our ideas are sound. If you focus on the economics, if you focus on politics, you can, these are sort of lagging indicators, I think. And but if you focus on ideas, that's the leading indicator, and we're winning. And I think we will continue to win. And the more failures we have, the more winning we'll be doing.
We've still had a lot of products and services. To add your points there, we've still had a lot of products and services come out the last couple of decades. So the price of computer microchips, internet connectivity, the cost of the internet, getting on the internet, cost of computers, those things have all improved. I mean, we have a computer, an amazing computer that's better than the computers NASA had for space exploration initially for rockets. So we have those smartphones, better computer now in our pockets. So yes, there's been an immense technology improvement. So the free market, the small amounts of capitalism we still have when governments and central banks don't totally muck things up since 2008, there's still really nice things that hardworking people can produce.
Yeah, I think you make a very good point. And, I don't want to go full Cathie Wood on you right now, but
let's not.
And look, I mean, I've always thought that, I was a skeptic. I was critical of Cathie Wood during the bubble, but I thought she made some valid points. And that is that there are declining cost curves out there. And you mentioned some of them. We also have the cost of sequencing the human genome. It was first done, I think, in 2000, roughly, for about $1 billion. And, alumina has been a driver of costs coming down. And we're now, I think, well below 1,000 on our way to 100. And, when we get to those levels, every baby that's born in the developed world is going to have, its genome sequenced, and we're going to be collecting data, and we're going to learn from this. And, so, yeah, you can focus on all the negatives of the healthcare system, and it's 2/3 socialized and all the rest of it. But, there will be opportunities that come out of this. So I don't, we want to focus on the deflation because that's what's going to, it's going to lead to opportunity. I mean, I saw this with, you talk about the computer revolution and Moore's law. I mean, I saw this with Dell Computer back in the early 1990s, and they were really riding that wave. And you can criticize Elon Musk all you want, but the guy did have a certain amount of vision, and he saw that costs were coming down, and he was able to ride that. Now, there was obviously the whole green movement; he was riding that as well. So it's a mixed bag, but yeah, there is a lot of innovation that's going on, and this is this is a positive thing going forward.
But your thesis, and based on central bank behavior, is that there's going to be a reverse wealth effect and then asset price deflation for a while?
Yeah, deflation is a good thing. I think, everybody is not everybody, but the central bankers and certain people, the way they're wired, they think that deflation is a bad thing. We just talked about it. It's a good thing. Natural deflation is a good thing. I would say also, when you have an artificial inflation and you create a massive bubble, especially in credit that's highly leveraged, that the market, you talk about the free market forces that are still out there, they're going to overwhelm the central bankers, and they're going to force prices down. That's the natural tendency. Now, look, we can always have a crack up boom. We can talk about that potential as well. But right now, I think as long as the central bankers are on pause, and if any, they don't even have to do anything. If they just go on pause, I think the natural tendency is we are going to have an asset deflation. And, right now we've seen the first effects of price inflation have hit the lower income levels. And, we've certainly seen that with Walmart, the Walmart results. But my thesis is that, we're just kind of getting warmed up in terms of the asset deflation. And that reverse wealth effect is going to climb the economic ladder. And I think we're going to see pain in that area.
So for our listeners out there, what I've called a reverse wealth effect is like the worst case scenario for the Fed, because the Fed and the U.S. government tax revenues, so state and local government tax revenues for real estate, federal government tax receipts for capital gains on stocks, bonds, real estate, all these other asset prices, crypto, all these other asset prices that were going up. The federal government was just loaded with growing tax receipts from that. Now the reverse is happening. Worst case scenario for the U.S. government and the Federal Reserve Bank, you have higher consumer prices, you have stagflation, more people are waking up to government policy of intentionally inflation, and now you have falling asset prices because the Fed's pretending, at least I would argue, pretending to fight inflation because they can't raise interest rates too much or they're going to crash everything. But you have asset prices falling the more the Fed hikes interest rates. And Kevin, that really creates like a vicious cycle, because you've talked about this, and I know you posted a lot of charts on your Twitter with the amount of margin debt. So credit in the system for hedge funds, for family offices, for retail traders on these stock trades, these crypto trades, all the amount of leverage that these people have bought the assets with is absolutely insane.
Yeah. So let me address a couple of things. First with the margin debt. We had I'm looking at the margin debt figures right now that FINRA reports, a regulatory body, and they peaked in October of last year at 936 billion. The June figures, we had a pretty good drawdown in the stock market. The S&P was down 8%. And we're at, as of the end of June, we're at 683 billion. So we're 27% off the high. Of course, we've had a pretty good rally this month, so you can expect that there's been a little bit of a bounce back. If you look at the previous bubbles, we had the unwinding of those bubbles basically cut margin debt in half. So they didn't really end until we saw a halving of margin debt. So by that measure, you might say that we're roughly halfway through this. Another way of looking at it is that the last two bubbles, margin debt got up to about 3% of GDP. That was the peak. This time this bubble was bigger, the so-called everything bubble, and we got up to about 4% of GDP, and we're at roughly 3%, maybe a little under 3% right now. So, by any measure, we still have too much of a debt overhang, and we've had really a pretty good sign that the retail investor has not been willing to leave the party. So, to see the end of this, we really want to see the retail investor kind of give up the ghost. The second part is talking about the central banks and the central banks kind of running out of bullets here, and I just think I would expand that to the government. I think that if we look at the general government, they've basically lived in this fantasy world for a very long time, where they haven't really had much in terms of constraints. And I think the world that you were describing, Jason, is one where tax receipts are going to be drying up, and they're going to have to make choices. There's no other way. They're not just going to be able to magically print money, not magically just borrow more money. Look at this idea of picking a fight with China. They're a creditor. They're a major creditor. If you look at the holdings of treasuries, the foreign central bank holdings of treasuries, they've been going down. And you're seeing the Fed is becoming a bigger purchaser, a bigger owner of government debt, and foreigners are becoming less. So I think we're going into a very different world. I think it's a world where government just doesn't keep on expanding, and we're going into a world of constraints, and there's going to be some really tough choices. One of them is at the military level. I just don't think we're going to be able to keep expanding the military and maintain, be the world's policeman. So we're going into a very different world, a multipolar world, and we're going to have to make choices politically. Do the baby boomers get their Social Security checks, or do we keep the military-industrial complex going? And some of these other things as well. It's not just that. Well,
and there's bullshit, I would call them bullshit articles that are coming out blaming my generation or younger, the younger millennials, the Generation Xers, for us creating the inflation, but we're really the ones who are working and paying into the system, and we're not going to get any of the unfunded liabilities, any of the Social Security benefits, any of those things. So it's just unfair to the younger generations of working young adults now who are paying into the system, and they're really seeing that they're not getting much. And I think that's why a lot of those younger adults saw this, and that's why they went over the last 18 months, they got their stimmy checks, and a lot of them, men and women, started just insane amounts of gambling, similar to the 1920s prior to the October 1929 crash. It reminded me of that, studying that, learning about that, Weimar Republic, Germany, that type of gambling and speculation on stocks and altcoins.
Yeah, it's a good point. So, a couple of things about what you said. One is that when you get into periods of desperation, and this is what's kind of interesting here, is that we have this manic period, but yet there's a certain depression going on at the same time. And when that happens, there is a tendency for some to basically just gamble and say, what the heck, let's try anything. They're desperate for anything, and I forgot my second point, so we'll just leave it at that.
Well, I want to ask you about this anti-bubble. So you did, for our listeners out there, and I'll put a link below the video in the information description section. You also did another recent interview. You talked about an anti-bubble. So we have this everything bubble that especially the Federal Reserve Bank, but other central banks have contributed to since 2008, 2009, inflating asset prices. They called it the wealth effect. It really created more wealth disparity. Now your thesis is we have an anti-bubble. So explain to our listeners what an anti-bubble is.
Sure. So when you have a bubble, you could think about it as maybe the water level where you have a water spout, let's say, and the water is just pushed up. And then, where does that come from? Well, it comes from the surrounding areas. So you have a receding of the water line around that spout. So this is what tends to happen with bubbles, is that you get bubbles in typically a narrow area. That's the way they've operated in the past. Like the tech bubble in 2000. That was really a bubble in very narrow, sector related. It was all about the new economy. But at the same time, you had people were selling the old economy furniture to buy more new economy lottery tickets. So it's almost like a mirror. These anti-bubbles are like a mirror. And you could go back, let's say, the NASDAQ peaked over 5,000 in March of 2000. Well, the 6 months leading up to it, of course, there was a big run up in the NASDAQ, but you had a decline in Procter and Gamble and Church and Dwight and Sanderson Farms and all of these old economy stocks, and they were selling off 30, 40, 50% and more. So when the NASDAQ peaked in March of 2000, those stocks actually rallied. They actually had a really good run at the rest of 2000. So that's the feature that we see. And I was looking at the last 50 years, starting with the Nifty 50 bubble, and we've had just bubble after bubble. You had the late 90s and the early 2000s crude oil bubble, and then you had the first wave of the personal computer bubble in 1983, and then you had a takeover bubble in 89, and you had the Japan bubble in 89, and then of course you fast forward to the tech bubble in 2000 and the credit bubble in the mid 2000s, and then the bubble that we have today. Well, so the first point I was trying to make is that the lesson here is to recognize this pattern, and that once you recognize it, don't worry about the bubble. Just try to avoid it. Try to avoid, you might be able to, if you're a nimble trader, you might be able to take advantage of it, but I'm a terrible trader. So I think the best advice for investors is just step away from the table and go fishing in the anti-bubbles. So the other lesson about this pattern is that bubbles have a false belief system, okay? And there may be a shred of truth to it. So let's take the internet bubble, the dot-com bubble in 2000. The belief was that the internet was going to change the world. Well, that ended up being right, okay? But the false belief part of it was all about first mover advantage. Okay, so it was all about it. As long as you got there first, you were entitled. You were destined to just carve out a big chunk of real estate, and that failed absolutely miserably. Okay, so I guess we could. Do you want to apply that to the everything bubble, Jason?
Yeah, sure. For our listeners out there with the internet stocks, I mean, like pets.com, a lot of those first movers, they failed. They didn't get revenue. They didn't get earnings. They didn't have free cash flow. And then later you had companies like Amazon, Google, Facebook, others. So later came a lot of the other technology companies that actually succeeded. Yeah. And, it's a pretty good pattern. The pioneers take the arrows in the back, and it's the first wave is dangerous. It's the second wave where the settlers get rich. And it's interesting, and this is something I think that the bears, present company included, missed in this period after the tech bust, was that
there were going to be some huge fortunes made, the Amazons and the Googles and even Facebook/Meta. But we saw the same pattern in the personal computer bubble that I mentioned in 1983. When that burst, you had a wave of companies going public, like Compaq Computer in 1983, I believe, which was around the peak of the bubble. But you also had Microsoft around that same time. And then later in the decade, you had Dell. They went public in 1988. So it was that second wave where the settlers got rich and where the big fortunes were made.
So what do you think are some of these like post-crash or anti-bubble stocks or sectors now that our listeners should be looking at for values, maybe after that second leg down where those margin calls, that vicious cycle kicks in, we potentially either grind sideways or we go one leg down more in asset prices, and then there's really good value?
Well, first, I think it helps to identify the false belief, okay? And I really believe that this everything bubble is unlike anything we've ever seen before. And part of that is because we have a bond bubble at the epicenter, and I would say a sovereign bond bubble. When you have the lowest interest rates in 5,000 years of recorded history, and you have, I don't know what it got up to, $15 trillion of negative yielding government bonds. That is a bond bubble for the ages. And if you go back over the last 50 years, we never saw anything like this, okay? So what is the false belief system today? I think it's the idea that the government is the solution to all problems. I think this is, the millennial generation, the younger generation have been drinking some of this Kool-Aid, obviously. And so I really think that is the bubble, and or a series of bubbles. And so what I'm trying to do is avoid all this. I think, first of all, we could look at the bond market. I don't think bonds are going to help your portfolio. I don't think they're going to be a good shock absorber on the downside. So we've got to basically go fishing somewhere else. You look at, we talked about ESG and commodities, especially energy. There is, I think, because of that, and again, this is a kind of a false belief in government, a belief that government can just decide that everybody's going to drive an electric vehicle, and we can just make this smooth transition as long as they pass a law or wave a magic wand. And now we're finding out that it's not that simple. So there's been a big underinvestment in energy, and so that's, to me, that's the anti-bubble. Central banking, we have the great monetary experiment. That's the bubble. What's the anti-bubble? It's gold. I'm kind of agnostic on Bitcoin and all the rest of it. I guess I'd be more of a skeptic, but I think gold is the anti-bubble. I think the other huge anti-bubble is that you have a politicization of big business. Business has been somewhat corrupted. I think they've been corrupted by bailouts. I think they've been corrupted by wokeness. They've been corrupted by political capitalism, all of these things. And we've had over the last 5 years or so, we've had about a $1.5 trillion swing out of actively managed equities into passively managed equities. So they've gone largely into the S&P 500. And
that's market cap weighted. So those are index funds. So the big companies that are already big and fat, they get even more capital. Their stocks grow even more.
Right. So that, to me, that's a massive bubble. And that's a conversation, if you want, we could continue, looking in. So I think really what you want to do is you want to avoid companies that are, I think where the lesson here is that you want to avoid risk, obviously, and risk is in the bubbles. That's clear as day. And so, where you're going to have woke cultures, you're more likely to have it in larger companies.
Look at Netflix.
Yeah. If you look at, I made a list of companies. I came up with 5 companies that to me were amongst the most woke. Netflix was one of them. Disney was one. Let's see, BlackRock, Google, one other, you could probably mention it. Anyway, if you look at those companies, I just checked, we've had a little bit of a rally, but when the S&P was down 20%, that list of 5 companies was down 40%. So you're starting to see a price paid for kind of drinking this Kool-Aid.
People are tired of being preached to. They don't want to hear, constant messaging. They just want like normal entertainment. I mean, if you watch a movie or a TV show or sports game, you don't want to hear constant political messaging 24/7, 365. You're watching these forms of entertainment, sports or movies or television shows to get away from that.
Exactly. And, I think this is what's important right now is that I think that we're at a major inflection point. We've had, probably going back to the signing of the Constitution. My father is a big student of history, world history, Austrian economics, and he's basically saying that the trend towards centralization really started when we tossed out the Articles of Confederation and we adopted the Constitution. I know that's probably not a popular view, but we've had a pretty good run in centralization, big centralized government, 250 years or so. And I think that when you get these bubbles, and if I'm right that the underlying false belief system is the government is the solution to all problems, that we are reaching some kind of an inflection point.
Well, hopefully we wake more people up, start questioning the government, start questioning these bad policies that they're being lied to constantly. We have like definitions now of recession being changed, and the consumer price index, I call it the changing propaganda index. That thing's been constantly changed. So the more people we wake up, the better. I want to get your thoughts though, Kevin, on real estate, because I think like the last asset market that's like, it hasn't crashed yet. You were there in the housing bubble, 2007, 8, 9. I know you were a little early, but you profited handsomely. Barron's featured you in an article for your market call on this. You ended up doing very, very well. How many more Fed rate hikes can the Fed do before U.S. home prices crash?
Okay, so first of all, I think that the Fed is almost irrelevant at this point. They are not controlling anything. And I think this is also something that's important, this idea, this belief system that basically the government is a solution to all problems and the government can control things. I think we're now at the point where I'm paying attention to the bond market. I'm not paying attention to the Fed. I feel like they're almost going in different directions. You see the Fed, look what's gone on recently. The Fed has been raising rates and the bond market has been rallying. Okay, so that tells you that the Fed is just completely behind the curve and that they're not controlling anything. They're just in reaction mode. So, what we had was the 30-year fixed rate was around 3% at the beginning of the year, got up around 6%. I've seen, if you look at the median price of a home, the fact that the home prices have increased and then rates have increased. That means the payment, the cost of ownership has just about doubled over the past maybe couple of years. And so I just don't see where any of this is sustainable. And
to add your points there, I look at a U.S. consumer. I wanted to ask you this. So this ties in with the U.S. consumer. When I look at a consumer now, the consumer is just getting absolutely killed for rent, getting killed for mortgage increases, getting killed for gasoline, diesel, electricity costs, food, healthcare, all the basic necessities to even have like a halfway decent life. All these costs are up enormously now.
Yeah, and so it doesn't bode well for housing. It doesn't bode well for discretionary, big ticket discretionary items. There's no doubt about that. And the way to resolve all this is we need a deflation. We need to bring the price. This was the great fallacy that they could just keep on inflating asset prices to oblivion and that this would work. And it's not going to work. You have to. And you talked about the younger, the millennial generation being screwed, and yeah, they are being screwed by this whole situation. And to them, they need housing prices coming down.
I totally agree. I mean, cheaper asset prices, my generation, we could save more. There would be incentives for us to go to work and grow our incomes. We could buy more assets. For your generation, the boomers, Kevin, asset prices falling now, worst case scenario, as your generation is either retired or getting ready to retire. Now we're seeing all these news stories out from the Wall Street Journal and others about boomers who need to go back to work, need to get another job. I think the Wall Street Journal just ran an article this week about how the upper middle class, these asset prices coming down has drastically cut their income and their retirement, their asset values.
No, that's exactly right. And it just the reality is, this is what's coming down the pipe, and I think all you can do is just recognize that it's happening the best you can and try to prepare. Hope is not an investment strategy, and if I think that you can't. I've talked to so many people who plan their retirement around, the stock market just continues to go up, if this, if that. I think you can't really play that game. You just have to look at what is most likely to happen and try to prepare yourself the best way. And I think the good news is that the bad news is that there are places that are overpriced and bubbles and dangerous, and all you can do is try to avoid those. If you are a millennial, try not to lock yourself into an expensive mortgage. And if you're a baby boomer, if you're in that boat, try not to have all of your money in the S&P 500 and just put it on autopilot and think that it's a piggy bank.
And if you're a millennial right now, the dollar is relatively strong, even though there's inflation, but relative to other currencies is strong. Fast prices are coming down. You could grow your income, build your savings, start buying assets, slowly accumulate wealth over time. That's how people used to get rich. We'll see what happens with central bank policy. But I want to transition now, Kevin, to what you said were part of your anti-bubble strategy, commodities. How serious do you think the global food and energy crisis is? And in your opinion, will it last for many years?
Well, I saw there was a cover of The Economist, and it talked about the food catastrophe, the coming food catastrophe. And I posted something on Twitter about this. I showed wheat prices, and then three magazine covers. I think two were by The Economist, and one was by Business Week, Bloomberg Business Week. And when they came out with these catastrophic covers, it was always at the peak, and I mean really close to the peak of a grain bubble. And we've obviously had a big move up in grains. So that's just something that got my attention. And I thought, okay, this is the inflationary side of the boat's getting a little bit crowded, and it might be time to tap the brakes, especially since I think the next act in this play is that we're going into a recession, and that you talked about it. You just mentioned, Jason, how everybody is getting squeezed. That's demand destruction right there. And now, obviously, people are going to eat. You're going to get less demand destruction there. But at least with food, it is not. It's not like fossil fuels where. They are renewable. There is certainly a lot more substitution in food. So I think that, when I read about these really dire predictions, I'm just kind of pushing back on that. I don't think that plays out. I'm much more concerned about the energy situation. So I think we might get some rays of light there, some better news. And we've already seen the commodity prices. We've already seen a pull back in grains by about 10%, and even oil prices and gasoline prices to a certain extent. Now, some of that might be a little bit artificial.
Well, not natural gas prices. I mean, natural gas prices, and that's big for electricity generation. It's big for fertilizer, natural gas prices. You look at liquefied natural gas exports into European Union, United Kingdom, Asia, the US natural gas price. I mean, I was a natural gas bull in the first quarter of 2020 with all that extra supply, all that shale gas byproduct that was flared off. That supply went offline. And now the US is going to be exporting, I think, doubling the liquefied natural gas exports by 2030. Looks like we have a natural gas bull market. And then with all these fertilizer exports bans, I think there will be more food available. Unfortunately, I think it's going to be at a higher price. I did speak to farmers after my first Doomberg interview, I think 4 months ago. They were telling me they skipped a planting season because of how high the fertilizer costs are. Well, eventually they're going to have to order more fertilizer. We will get more food. It's just not going to be cheap anymore.
No, it's not. And it was a good call on the natural gas E&P companies. We recommended a couple of them when I first started the newsletter back in February of 2020, and I was just looking at EQT is one of them. And when we bought that, natural gas prices were just totally depressed. They were under $2 per MCF equivalent, and we're now, I just checked, we're at about $8, so a quadrupling in the spot price. But if you go 5 years out, it's $4. It's half as much. And even if you go 1 year out, it's under $5. So it's but
you're talking on the futures curve. Now, I'm not sure I fully agree with that, because the futures curve in oil is saying oil is going back down to 70, where there's no reinvestment into new supply. So I'm not sure I agree with the futures curves on the oil and natural gas. So we'll see.
Yeah. And look, I agree with you. You still have to make a judgment about all this. But look, we're still long. I just looked at the numbers on EQT, and the thing is, these guys are hedged. I would think most of them are hedged, and pretty far out. And so they're not going to that $8. They're not going to capture. But they this year EQT is going to get maybe a little over $3, maybe 3 1/4, 3 1/2, and they're generating. Well, let's put it this way: the stock, when we bought it, I recommended it, I think, around 5, and it's at 42 right now. So it's had a pretty good run, and they had a market cap of less than $1.5 billion. Now the market cap is, I think, 17.5. They've issued some stock over that time, but they're projected to generate free cash flow of $2.2 to $2.5 billion this year. So it's just amazing how much the fortunes of these companies have changed. But it also, I think, Jason, it goes to show that they're generating. They're generating that much cash flow. So your free cash flow yield is like 12, 13%. And that's basically locked in, for the next few years. Imagine if they're able to, that's capturing 3 1/4. Imagine if they're able to capture 4 or 5, forget about 8, that would be just complete pie in the sky. So I think that's the thing, is we can't get too wrapped up in terms of the pricing, and you almost have to look, as a long-term investor, you have to look at the fact that these companies are. So I don't think there's a total correlation in terms of the price and in terms of the value of the stock.
I would agree with the commodity prices versus the value of the stock, because I think the market is still valuing a lot of these natural gas producers in the US at around $4 natural gas. So they're still making free cash flow. Their stocks are up, but they're not getting the valuation pricing at $8 natural gas. So the market is heavily discounting the potential for some of these natural gas companies going forward.
Yeah, I would agree with that. And I think you could say that about gold, the gold mining area as well. They're discounting. I mean, prices right now are, what do you think, discounting like $1,400, $1,500 an ounce gold.
Well, a lot of, if the miner is an open pit miner, they've had to deal with a ton of really high cost energy. And this is a major issue for the entire global economy, because you've had some larger gold miners like Agnico Eagle, and they did hedge a good chunk of their oil and diesel costs, but they couldn't hedge the entire thing. So you have sky high diesel prices here in the Western world. It's still a mess for a lot of open pit mining companies.
Yeah, and my understanding is that the underground mining companies have a different cost structure, and I think are they lower? They have lower exposure to energy costs.
They have, their energy costs are based normally on, they have a lot more mechanized stuff, so they're going to have a lot more electricity exposure. But both miners, like, they still, for like the crushing and the milling and the chemicals and all that separation, they're still using a ton of electricity. It's the open pit miners, though, that have to use more diesel, because they're putting all this uneconomic rock on giant, 2-ton trucks, and then they're trucking it to the conveyor belt so it gets crushed. So they're burning diesel 24/7, 365 at these open pit mines, whereas like the underground mines are not doing that.
Right. Yeah, and we've had Agnico Eagle reported yesterday, and then Newmont, I think, a couple days ago. And I think the market got pretty spooked about Newmont. Their costs went up to about $1,200 an ounce on an all-in sustaining cost basis. And Agnico Eagle, though, their costs were about flat. As you mentioned, they did a better job of hedging, and Newmont doesn't. I don't think they do a lot of hedging. So, yeah, they're all in somewhat different situations. But I mean, it's the gold stocks are. It's a tough business, but I mean, even with the costs going up, they're still generating a lot of free cash flow. And I think that's the point with all these commodities, is that even though we could very well see, spot prices of commodities come down from these really high levels, these companies will still free cash flow a lot. I mean, you look at CF Industries, a fertilizer business. I think right now they're running a free cash flow yield of like 25%. It's just, these companies are really making an obscene amount of money in some cases.
From your experience, Kevin, if the cost for these commodity companies keep rising, and let's say energy costs, electricity costs, labor costs, if these costs keep rising for these commodity companies, does that mean commodity prices are eventually going to have to, and this doesn't mean the short term, maybe like over 2, 3, 4 years, commodity prices are going to have to rise and to offset these cost increases for the producers, or there's going to be supply problems?
Yeah, I mean, something's got to give. Something's got to give, and I think at the end of the day, what's got to give is that, first of all, we're going to experience a recession, probably a pretty deep one from all these things. That's one thing that could possibly help the situation, but also just kind of a reallocation of resources, and that we've had this general underinvestment in resources. And I'm concerned about companies like the oil service companies, and being able to just, right now they haven't really cranked up supply, so you're not seeing those companies really just go out and have to hire a bunch of people. But I think it's going to be difficult for them to do that. And so the next part of the cycle where we're trying to increase supply, we may get a bit of a respite. We may get some demand destruction. That may be what at least gives us a breather for a little while. But I think at some point you're going to have to increase supply, and it's not going to be like flipping a switch. It's going to be a kind of a painful, messy process.
Well, if commodity prices fall and there's demand destruction and the dollar stays strong, I mean, that's worst case scenario, in my opinion, for emerging markets, because emerging markets, a lot of this agriculture and mining, a lot of the commodities businesses are not here in the United States or the Western world. They're exported to emerging markets and developing countries. So if they have a strong dollar relative to their own currency, and then they have weak commodity prices, and then higher costs at the commodity producers, they're getting hit all different types of ways with different cross currents.
Yeah, and the question is how much. I still think we're in a long-term bull market for commodities. So I'm not sure I'd want to really bet against the emerging markets, but it's going to be a messy situation and kind of hard to predict. But I think that the master resource is energy. That to me is, and that's why I think you just have to own some. It's almost like owning gold in a portfolio right now. You ought to own some gold as insurance, and I think you ought to own some oil in the ground, natural gas in the ground as insurance as well. I don't think you can, because all of these other these costs that you talk about, one of the main ones is going to be energy.
Yeah, I think that's a really big theme is higher energy. I'm just hearing that, it's especially the commodity businesses. If you're a food producer, if you're a fertilizer company, if you're a mining company, your biggest input cost, besides cost of capital right now for a lot of mining companies, because cost of capital for a lot of miners, unless you're a low-cost producer like Agnico Eagle or Newmont Mining, capital is not really available. Your biggest cost increase is your energy and electricity costs. That's something that these companies historically don't hedge, and especially with rising costs, even if they did hedge like a year or two ago, they didn't hedge enough.
Right.
So as we wrap up here, I have one more question for you based on contrarian value investing stocks from your coffee can portfolio. This environment is very volatile because of rules changes by central banks and governments. They're fighting inflation right now. That's a narrative. They're taking the bubble. They're taking the air out of the asset price bubble. How should retail investors be looking to protect themselves or to beat inflation, maybe maintain their standard of living or grow their income in this type of environment?
Yeah, well, that's a big question and hard to give a soundbite answer. I think again, you have to recognize that where the bubble is, and a lot of this game is avoiding risk. And so, I would avoid a lot of the companies that are in the S&P 500. I would avoid bonds. I would avoid areas that are being basically promoted by government, like electric vehicles. I would be skeptical of things that are just have been too hot, and everybody and his brother wants to get into them, like blockchain and cryptocurrencies, where they certainly fit that bill, at least last year. And so I would just be, I tread very carefully and then focus on the anti-bubble. There's the good news in all of this is that there are a lot of really, really cheap stocks. If you start fishing where others haven't been fishing, and they're all over the place. I mean, you could look at a company that I've recommended in the past is Skechers, and all you have to do is get on Yahoo Finance and look at Skechers. Skechers is the third largest casual footwear firm in the world. Okay, they're not in the S&P 500, and one of the reasons why they're not is because it's founder run. The insiders own something like 26% of the stock, and the indexes are float weighted. So companies with high insider ownership have a tougher time getting into the S&P 500. These are companies that are going to be less likely to be corrupted by political capitalism and wokeness and all these, official narratives. I think that it's a much safer place to go fishing. So if you look at, let's say, a company like Nike versus Skechers, the growth profile, I'll take Skechers any day of the week, and yet the forward PE is probably double Nike. You could do the same exercise with active managers, even T. Rowe Price, something like that, which is going to be a little bit pricier than some of the others. But you could just look at actively managed, active managers, asset managers, and compare them to, say, BlackRock, and you're going to see that BlackRock trades at a big premium. So that to me it's not all doom and gloom. It's an exciting time. There's a lot of opportunity out there, and you just have to turn over a lot of rocks and look where others aren't looking.
And there's what the old Chinese proverb that where there's crisis, there's also opportunity.
Absolutely. And I think this is, we have to think about this in terms of the tide going out. There's another saying, I guess this is a Buffettism: when the tide goes out, you find out who's been swimming without a bathing suit. And so for investors, this is a great opportunity to, hopefully the tide continues to go out, and we will expose those money-losing ventures that basically were propped up by a decade of zero interest rate policy, and we're going to find out which ones are able to, turn to profitability, which ones are not, and we're going into this very different world where, like, I looked at the results of Amazon.com. They just came out after the close, and their retail operations are losing money. They're losing more money internationally. That's really been a sore spot. But they're also losing money. They've lost money now for the last 3 quarters in North America. So that tells me that at some point, and the company's being carried by AWS, where the margins are great and they're growing at a rapid clip. But investors are becoming very unforgiving when it comes to money-losing companies. And so if Walmart has to basically turn their retail operations, has to get them profitable, that to me says that the rest of retail is going to see their profit margins go up. So that, and to talk about a contrarian play, looking in retail is, most people think that retail is just a graveyard and Amazon's going to put everybody out of business. But, I've spent the last 5 years, spend a lot of time in retail, and there's just a lot of bargains out there and companies that I don't think are going to go out of business.
Do you think then their thesis with this inflation, then I know the last quarter, Walmart and Target, they had too much inventory. So you think then what these companies are going to do, they're going to discount the consumer discretionary items. They'll clear inventory. They'll have sales. Those items will be sold for cash. They'll get what they can. And then on the staples, the stuff that people still have to buy, they're going to be raising prices. And on that, they're going to have pricing power.
Well, okay. So I think, and maybe this is wishful thinking on my part, but I think we will see at least stable prices when it comes to food, maybe slightly lower prices. And I think we'll see, and we're not just will see, we are definitely seeing, when it comes to discretionary items, big ticket items. I get Williams Sonoma. I get their emails every day. And if you go back a year ago, there were hardly any sales. And now it's just, huge sales going on all the time. They're discounting. So, yeah, the market it's going to sort this out. And I think you will. I like the idea of owning some of the more defensive in the food area and the staples area. I like owning some stocks there. But I think, and then even in discretionary, there's a whole range, from in terms of retail, things like footwear. To me, that's not quite as discretionary as a refrigerator.
Well, Skechers sells a lot of their footwear are for people who work like normal jobs. So, I mean, like, people have to buy their shoes for work. They have to reorder them. So that's like a constant supply of, that's a constant amount of demand. And then people have to keep reordering the product. So it's not like a big ticket item, like you said.
Right. So you just don't want to broad brush these areas. And what I like to do as a long-term investor and as a contrarian is look at where the narratives are, look at what's scaring the pants off of everybody, and try to look, just dig in and then get into the weeds and look at these companies and find out what's going on. And I think this whole narrative, it really goes back to 2017 when Amazon bought Whole Foods. That was when I think the narrative kind of switched to, well, everybody's just going to get wiped out if you're in retail. And that's when I really started to spend a lot more time digging in. And what I realized is that that's just not going to happen. And I think if anything, Amazon, at least in retail, is probably, in terms of their market share, I'm not saying that it's at a peak, but I just don't see where they're going to be making enormous market share gains. And you have other companies that have adapted. They've been hit. These retailers have been hit with everything, not just Amazon, but they got hit with COVID. Some of them got hit with forced lockdowns. They've been through fashion cycles. They've been through now supply chain issues. And it's really amazing how, even a company like Skechers has remained, they haven't skipped a beat. And they've had to deal with supply chains. They've had to deal with inflation, all the rest of it. But there are a lot of companies like that are just continuing to get stronger and stronger. And I love adversity. I love to see the tide go out, and I like to see, who's got a bathing suit and who doesn't. And that's the process I think we need to pay attention to. And with retailers, we've been seeing the tide go out now for 5 years. Okay, and so it's becoming very obvious who the roadkill is. Companies like Bed Bath and Beyond, they're in deep trouble, right? They're probably going to go bankrupt. But guess what? Somebody's going to pick up that customer. Somebody's going to take that market share. So there's always. I'd rather go swimming where the tide is going out and where the herd is vacating. There's usually, if you dig in and you challenge the narrative, there's usually something going on that is interesting.
And Amazon has forced Walmart and Costco to become more competitive. So over the last 4 or 5 years, I think those companies have gotten stronger from the competition. They've adapted. They've added new services. Walmart added a delivery service. Their website, ordering from their website has gotten a lot better. So these companies do adapt. Some of the larger ones, it takes more time. But in terms of the anti-bubble and the tide going out, I think gold stocks, a lot of these companies, like you said, they're hated. Since September 2020, the shares have been in a trading range or down. A lot of the junior miners are not getting funding right now. So the larger companies with free cash flow, like a Newmont Mining and Agnico Eagle, they're going to go and buy assets for pennies on the dollar. And 2, 3, 4, 5 years from now, if they can hedge energy costs and metals prices don't crash and stay low for a long period of time, I think their metals prices 2, 3, 4, 5 years from now are going to go higher. These companies could be minting free cash flow with more assets and more cash flow at good margins a few years from now.
Yeah, no, I agree. I saw something, ASA Limited, which has a very large portfolio of juniors and exploration and development companies, mostly in Australia, Canada, and a little bit in the United States. But, so geographically, relatively stable areas. And they showed a graph over the past 25 years or so of junior gold mining companies, the enterprise value to the per ounce of gold of approved reserves. And it's been in a range of about, I think, $20 to $80. And we're now at $41. Okay, so, not at the absolute lows that we saw in 2016, but we're back to levels that we saw in the middle of 2020. Okay, so I agree. There's, and this is what to me is what's exciting. There is, if you know which areas to avoid, it's kind of a process of elimination, and you just go fishing in some of these other areas. And I think there are lots of opportunities. In fact, as a macro guy, Seth Klarman used to say that he thinks he worries macro, but he invests micro. And so, from a macro standpoint, it's scary. It's with the stuff that you and I talked about, Jason. It's real, and it's going to be messy to watch all this play out. But from the micro side, I'm just seeing so much more opportunity on a broad basis than I've seen in a very long time.
And you have the coffee can portfolio now for retail investors. So as we wrap up the interview here, please tell my listeners how they can follow you on Twitter or take a look at the coffee can portfolio.
Okay. Twitter, Well, let's go to the coffee can portfolio. The website is thecoffeecanportfolio.com. Pretty simple. You can Google it. You'll find it. It should show up at the top. And then my Twitter handle is @KevinDuffy1929. And that is a reference to obviously one of the previous bubbles and not the year I was born.
Well, there's actually a lot of similarities prior to the October 1929 crash with like the government policies and the intervention and the rampant speculation. I mean, like we were discussing earlier as we wrap up here, I mean, there was a lot of rampant speculation with the stimmy checks, the lack of supply, gambling on asset prices. There was tons of margin debt with retail investors prior to the October 1929 crash. And I think we saw a good glimpse of that the last 18 months or so with people getting their stimmy checks and then also getting, before we started recording, massive amounts of margin debt on Robinhood app, on Coinbase to go and gamble and speculate on altcoins, NFTs, and stock options and meme stocks.
Right. Yeah, you mentioned Robinhood. That will be an interesting second quarter release. I love going through their numbers because you get a nice snapshot of the retail investor. So yeah, Schwab's a good example, but definitely Robinhood. And it will be interesting to see how much pessimism, how much bearishness has been generated by the past quarter. So we'll see.
And then Coinbase too, which gave out a lot of margin debt to a lot of retail investors that should not have gotten the margin debt to go gamble.
Yep, exactly. And unfortunately, it seems like every generation has to learn this lesson. As you mentioned, I'm a tail end baby boomer. I'm like the last 3 years of the baby boom. But the baby boom generation, we went through the tech bubble. That was our lesson, and every generation, it seems, has to go through that, or they're brought up by a generation that, let's say, goes through a depression, and so they're going to be a little bit more gun shy, and they're not going to experience quite the bubble that maybe our generations have.
Well, my grandparents lived in New York City during the 1929 depression. They were young adults and they didn't trust the stock market and stocks after that.
Oh, isn't it interesting to go back into your family history and to talk to others about that experience? And we have family on my mother's side who came from Germany, and they went through the Weimar hyperinflation. And the reason why they left was because they had a laundry and they accepted a note in payment. They sold it and that became worthless. And so, in the intra-war years, they saw the writing on the wall and eventually moved everybody over here. So yeah, we're all descended from survivors.
And we try to learn from past mistakes so we don't repeat them. Unfortunately, some people don't do that. They continue to make the same mistakes. Hopefully myself and my listeners aren't in that category, though.
Yeah, there's always, it's a great point. And this is not an easy game, and it's very easy to get tricked. It's very easy to, sometimes you have to learn very painful lessons. I've certainly learned some painful lessons myself and had to adapt and change things. And sometimes we can get fooled. We can get fooled by being right and thinking that this is just going to continue on forever. So I think you always have to be just very humble and always think about, what am I missing here? What, if it seems too easy, then it probably is, because this is a very complex game that we're playing.
I 100% agree. With the stock market that was ripping 8 months ago, and in Bitcoin 9-10 months ago got to 69,000. So a lot of people just kept putting higher and higher price targets on the stock market, higher and higher price targets on Bitcoin. So, and a lot of those people who had made so much money in those trading profits, they were new. They had not been in a bear market, and they're learning things the hard way now. They're getting those margin calls. They did not keep cash. They were not diversified.
Yeah, and you know what? But this is the way. This is the way we learn, and it's it's unfortunate, but at the same time, I think you do have to look at the silver lining, and like I said, I think we could look at 20% of the population who is wired a certain way, and they won't learn. They won't learn from the mistakes. They'll kind of double down on the toxic ideology that may have gotten them into trouble. But I think it's the other 80% that we have hope for, and yeah, this is how you learn. You learn some painful lessons and you move on, and that's how human beings progress.
Well, Kevin, thank you so much for your time. I really enjoyed our conversation. We ran over an hour, but I think our listeners are going to get a lot of valuable information and insights, and also a few stock picks from here.
Well, thanks for having me back. I definitely enjoyed the conversation, and I hope others do as well.